Hello, welcome back to class. We'll be talking about international taxation and transfer pricing, international taxation and transfer pricing. And we will look at the meaning and objective of international taxation. We will look at double taxation and relief method, the OECD and UN model tax conversion and convention, the transfer pricing principle, method and documentation, and base erosion and profit shifting framework. Looking at the international taxation, it's actually very important to know the core challenge. How do we allocate taxing right among sovereign nations in the global economy? And this is very, very, very paramount in international taxation and why it matters. The first is that businesses operate across borders in terms of subsidiaries, supply chains, digital services, and no single world tax authority exists, leading to potential conflict. And lastly, it matters because it enables profit shifting and base erosion, threatening national tax revenues. And it is actually essential. National taxation is essential for tax professionals, multinational enterprises, and policy makers to navigate this complex landscape. And the key principles of international taxation are one, the residence principle, and this is a country tax its residents on their worldwide income. And the justification for this is that residents benefit from public services at home. Another is the source principle, and this talks about a country tax income that is generated within its borders. And the justification for this is the host country provides the market, infrastructure, and workforce. And we also have the arm's length principle, which talks about transactions between related companies must be priced as if they were between independent companies. And the purpose of this is to prevent artificial profit shifting to low tax jurisdiction. And we have another very important aspect of international taxation, and this is double taxation. And when we talk about double taxation, it's actually a problem, and it is the same. It is the charging of the same income, taxing on the same income by two or more countries. And why it happens is as a result of overlap of residence and source principle. Example of this is a Nigerian company branch in the UK is taxed by Nigerian residents and the UK, which is the source. And the form of this is juridical and economic double taxation. And for juridical, it's the same income, same taxpayer, but two countries and two countries. And for the economic, it is same income, different taxpayers. That is company profit tax plus shareholders dividend tax as such. There are reliefs from double taxation, and this can be explained in two main categories. The first is unilateral relief, which is domestic law. And this deals with foreign tax credits, that is credits for foreign tax paid against domestic tax liabilities. We also have exemption method of relief, which is the foreign income is excluded from the domestic tax base. And we have a deduction method, which deals with foreign taxes treated as deductible expenses. And then we have bilateral relief, and this talks about tax treaties, and it is an agreement between two countries that overrides domestic law to allocate taxing rights and provides relief primarily via credit or exemption methods. We have the international tax model, which in this we will look at the OECD and the UN When we talk about OECD, this actually favors residence countries, typically developed capital exporting nations. And the key features is that it's strict permanent establishments definition, and another is royalty, which is taxed on only in the residence country. And another feature is a lower source taxation on dividend and interest. And under the UN model, it favors the source countries, typically developing and capital importing nations. And the key features is its border PE definition, which in example of this is 6 month construction site. The royalty is source country can tax, e.g. maybe 10%. And the last is higher source tax right on various income. We move to transfer pricing, which is a core concept. And when we talk about this, this is the pricing of transactions between related parties, that is subsidiary of the same multinationals. And the governing rule is the arm's length principle. And this talks about what would the price be if these two complaints were independent. And looking at the risk without it, complaints can manipulate price to shift profit to low tax countries, eroding the tax base of high tax countries. We have the methods of transfer pricing, and the traditional methods are: one, the comparable uncontrolled price, and this is compare price to an identical independent transaction. And another is the resale price method, which works backward from the price to an independent customer. Another method is the cost plus method. This deals with adding an appropriate markup to costs. And we have the transactional profit method. The first three had a traditional transaction method, and now we have a transactional profit method. And this deals with the example of this is transactional net margin method. And it compares net profit margin to comparable complaints. And lastly, the profit split method. And this splits combine profit based on relative value of contribution. The BEPS method, it's actually the base erosion and profit shifting hand. The problem is the multinational using legal but aggressive tax planning to shift profits to low or no tax location. And the global response to this is what the OECD and the G20 BEPS project offers, especially the 15 action points. And the key BEPS accounts, the action 5, which talks about counter harmful tax practice, action 6, which talks about prevention of treaty abuse, and action 7, it prevents artificial avoidance of permanent establishment status, and action 13, which enhance transfer pricing documents as such. And we have recent development from BEPS. It has a response to it. And the first is Pillar 1, which aims to relocate taxing rights of the larger multinationals to market jurisdiction where they have users or customers, even without a physical presence. And the impact of this is it's addressing the digitalized economy. And the second pillar is aims to introduce a global minimum corporate tax of 15%, and the impact of this is a reduction in the benefit of shifting profits to tax havens. In conclusion, international tax rules are evolving rapidly due to globalization and digitalization, and the BEPS project and Pillar 1 and 2 are fundamentally reshaping the global tax landscape, and mastering of double taxation relief, transfer pricing, and treaty interpretation is crucial for any modern tax professional, especially in the emerging markets like Nigeria. Thanks for listening.